Hi everybody, here's chapter 17, and this is actually a nice segue as we start to move kind of out of our financials section and into our managerial accounting section, because now we're not recording transactions like we have been in all the financial chapters, but we're actually using the information that we've collected to do some analysis and probably some decision making, which is what managerial is all about. So you'll notice there's not one single journal entry in this chapter. We've recorded all the information in the journal entries. We've used those to create our financial statements, and now we're looking at that. What does that really tell us? And so we're really digging deeper into the financial statements to tell us, to see what that tells us about the company. So when we want to look at the financial performance of a company, there always has to be some sort of comparison. Just the numbers by themselves don't really tell you anything. So you can compare it year to year. So how are you doing compared to where you were last year at this time, the year before that? You can compare it to another company, your primary competitors, like benchmarking, or you can compare it to the industry as a whole. So some of these statistics that we'll look at will vary wildly if you are a mattress store versus a grocery store, and so it's helpful to compare it to people in your industry. So there's three main ways that we can analyze the financial statements. A horizontal analysis is a year to year. So you're comparing your performance now to what it was a year ago. You could do quarters, I guess, but for most of the time it's a year to year thing. Whereas a vertical analysis is, we'll show that, but that's a great way to compare different companies, especially if they're different sizes. It's also, I think, vertical analysis is super helpful when you're looking at really, really big numbers, and so you kind of turn them into percentages, and it's easier sometimes to grasp. And then ratio analysis is the third type, which is really the bulk of this chapter, but you've been doing ratio analysis all along. They throw in a couple ratios at the end of pretty much every chapter, so a lot of these ratios we've seen before. So there's a lot of formulas in this chapter, but keep in mind you don't have to memorize them, right? Because you just have to understand what they mean. So don't get overwhelmed by the volume of formulas in this. You've got the formulas, you just have to plug the numbers in and then hopefully know what it means. The other thing in here is when a company puts out a publicly traded company, so a company that's out there buying or selling their stock, when they put out an annual report, it includes a couple different things. And one of the big ones is the MD&A, the Management's Discussion and Analysis. So this is their chance to kind of explain, I know our cash is a little low right now, or our debt's a little high right now, but that's because we just invested in something which is going to make us so much more productive in the future. So something that the numbers flat out don't tell you. This is their chance to kind of explain that. A report from an independent registered accounting firm that somebody else looked at these numbers, the financial statements, and then the notes to the financial statements. And the notes will include details on how they calculated these things. So the inventory method they use, FIFO or LIFO or weighted average, the depreciation methods they use, all of those things are, and a lot of times for these big companies, the note section is much bigger than the financial section because they're explaining lots of stuff in there. So that's, if you guys like to, if you like to do the stock market or at least look at it, all of these financial annual reports are available to the public if it's a publicly traded company. So you can look at those and see these types of things in there. Okay, let's talk about horizontal analysis first. This is the study, this is a percentage change, okay, from comparative financial statements, which means you've got two financial statements. And so you take, let me change that color, you take the change, how much it changed, divided by the base period times 100. This is just a flat out percentage change. This is not unique to accounting. The way I always calculate percentage change is the new amount minus the old amount, so the change divided by the old amount, or your starting point, okay? So the change divided by the starting point, and then you take that times 100. So if you were looking at the change from 2020 to 2019, you'd take that number in 2020 minus that number in 2019. That would give you the change. And then divide that by your starting point, or your old number, which is 2019, times 100. And that's percentage change. So you can say it however you... I always do new minus old over old. So if we look at... so you need two income statements or two balance sheets to do that. But in this one, it goes... right to left. So this is your new one, and this is your old one. If you had a comparative income statement that had 5 years worth, the oldest one's all the way over on the right, and it gets newer as it goes to the left. So this this is the change right here, the amount or decrease. So this is the 2020 number minus the 2019 number. So for instance, if we look at this guy right here, we can see that from 2019 to 2020, it went up by 12,000. Okay, that's the change right there. And then if we want that as a percentage, that's the change, which we just did, over the starting point, which is the 2019 number. Okay, so if we take 12,000 divided by 114,000 times 100, we get 10.5. So that's what all of these are right here. Even if you do negative numbers, we went from, oops, what are you doing down there? We went from negative 14 to negative 12 as an expense. So we went from 14,000 to 24,000. So our expense went up by 10,000. And if I take 10,000 divided by 14,000, I get 71, or times 100, I get 71.4%. So that's what you're doing in each one of these. You're just taking the change, you calculate the change first, and then you divide that by your starting point or your old number, and that gives you the percentage. You can do the same thing with a balance sheet. So if I look at cash, I can see that my cash went down by 3,000. It went from 32, again, this is your new, and this is your old. This is your change, and then this is change divided by old, which in this case is the 2019 number. So a $3,000 change divided by 32,000, that is a 9.4% decrease in this case. Cash went down. Or if I go down here, I can see that my accounts payable went from 68 to 73, so that's a $5,000 change. 5,000 divided by 68 is a 7.4% increase in accounts payable. So these are trends that you want to look for. Again, when you get into percentages, that's also super helpful when you're dealing with really big numbers. That sometimes it looks like a big number, but as a percentage, it's really not that big. So if you're dealing with a large company, I think taking things into percentages is super helpful. And then also, if you did this for multiple years, you can look for trends, which is important. So speaking of that, this is a trend analysis. Now, in this book, in this context, a trend analysis isn't a year-to-year-to-year change, which you can also do and is also useful. But in this one, everything is a percent of the base period. So the amount for any period divided by the base year. So everything here is a percent of the base year. It is not a year-to-year change. I'll show you what I mean here in a second. So what we do, okay, so the base year, this is the base year, this is the oldest one, right? You can see this is my newest, and this is my oldest, 2016. So I just take each number and divide it by this number right here. So if I'm doing the base year, I'd just be 750 divided by 750 is 100. For this one, I'm going to take 748 divided by 750 times 100, and I get 99.7. It went down a little bit. For 2018, I take 780 And I'm not comparing it to this one. I go back and compare it to that 750 again. So I get 104%. What that means is this number is 4% higher than the base year, okay? In 2019, I take the 803 divided by, go back to that 750 times 100, and I get 7.1%. So that tells you that sales revenue in 2019 was 7.1% higher than it was in your base year of 2016. And then 2020, I take the 858 divided by 750 times 100, and I get 114. So it's not showing you how much it increased from the year before. It's showing each one as a percent of the base year, which I think is a little bit different than probably how you're used to seeing trend analysis. So here's an example. They want us to prepare horizontal analysis of revenues and gross profit in dollar amounts and percentages for 2019 and 2018. So for 2018, I'd be comparing 2018 to the year before. For 2019, I'd be comparing 2019 to the year before. Also, it's asking me for gross profit, which we don't have, but I'm positive that you remember that revenue minus cost of goods sold equals gross profit. So we can just add that in here. 9890 minus 6250 is 3640. So I just subtract that. And 9690 minus 6000 is 3690. And 9135 minus 5890 is 3245. Okay, so we've got 2019 over here, and I'll do 2018 over here. And so the first thing they want, the change in dollar amounts and in percentages. Okay, percent change. So they want revenue and gross profit, right? So for the change in revenue for 2019, I'm comparing these two numbers right here. So I would take 9890 minus 9690, and so I get $200. And then they want that as a percentage as well. So I take that $200 divided by my starting point, which is the 9690, and that gives me a 2.1% increase. I'll do the same thing for gross profit. I'll compare these two numbers right here. So I went 3640, and I started with 3690. So that's a negative 50 is the dollar amount change. And then if I take negative 50 divided by my starting point of 3690, so again it's new minus old over old. And so this is negative 1.4%. We can do the same thing for 2018. And so I want the dollar amount change and the percentage change. So now let's erase all these lines so that's not confusing. I'm going to do these two numbers and these two numbers. So for revenue, I'm going to go 9690, and I started at 9135. So this is my new and this is my old to give me the change, which is 555. And then I'll take the change divided by the old. So 555 divided by my starting point, which is the 2017 number, 9135, and I get 6.1%. And I can do the same thing with gross profit. So 3690 minus 3245, I get a change of 445. And if I take 445 divided by my starting point of 3245, I get 13.7%. Now, that's all they ask you to do in here. But there's some important stuff for us to look at. What does this tell us? I mean, the whole point of doing this is to figure out what's going on with this company. And if we look over here, we've got a positive change in our revenue, but a negative change in our gross profit. And if that's a concern right there. Your revenue's going up, but your profit's going down. So what does that mean? Well, the difference between revenue and gross profit, here's revenue, is cost of goods sold, right? So if your revenue is increasing, but your profit's going down, that must mean that your cost of goods sold or your expenses are going up higher than your revenue is. And so if we look at cost of goods sold, the change there, 6,000 up to 250 or 6,250. So my cost of goods sold went up by $250. And if I take 250 divided by 6,000 as my starting point, I get a 4.2% increase. So that's exactly what's happening. Your revenue is going up by 2%, but your expenses are going up by 4.2%. So that means your gross profit is going down. If you're running a business, that's kind of important to know, right? And so you have to, if you want to turn around that profit, which you need to do because it's moving in the wrong direction, you either need to cut your costs or increase your revenue somehow. So you either need to sell more or increase your price, and that gets into a whole other branch of decisions over there, or you need to find a way to cut your costs, and you would need to cut your costs in a way that does not affect your income, right, or your revenue. So if we look at the year before, their cost of goods sold went from $5,890 to $6,000. So it went up by 110, and that's a 1.9% change. So in the previous year, your revenue went up by 6%. Your costs went up by less than 2%, which is why you see this nice, healthy increase in your gross profit, because your revenue's growing at a faster rate than your expenses. That's what you want to see. 2019, that is not what you want to see. So that's something that you kind of need to keep an eye on. Okay, so that's a standard horizontal analysis. Here it's asking for a trend analysis. So again, it's everything as a percent of the base year. So if we go 2016, 2017, 2018, 2019, and they're asking for revenue and net income. And so again, we just take, so the base year is always going to be 100. Then we take 9050 divided by 8950 times 100, and we get 101%. Then we take for 2018 9355 divided by 8950, and we get 105%. 9610 divided by the base year of 8950, and we get 107%. We do the same thing down here. The base year is always going to be 100. Then we take 5020 divided by 4300 times 100, and I get 117%. 6790 divided by 4300 gives me 158. And 7290 divided by 4300 gives me 170. So I can see that my net income is growing a lot faster than my revenue, which is good. Well, it means I'm holding my costs down, which should be a good thing. Okay, vertical analysis. I'm gonna cover vertical analysis, and then I'm gonna stop, and then I'll start the ratios in another video. Okay, so vertical analysis shows the relationship of every single item in that financial statement as a percent of its base amount. Okay, everything is just reported as a percentage of that base. Now the base, if it's an income statement, everything is reported as a percent of net sales revenue. So that's my base. So I take anything divided by net sales revenue. That's my base. If it's a balance sheet, the number that you use for the base is total assets. So all I'm doing in a vertical analysis, if it's an income statement, I'm expressing every single number as a percent of net sales revenue. If it's a balance sheet, I'm reporting every single number as a percent of total assets. So that's all we're really doing here. So for instance, let's say I'm talking about selling expenses. I would take this number as a percent of my base. This is my base. So everything here, everything in this column, I just divide by that net revenue, and that's what this percentage. So I take 126 divided by 858 times 100, and I get 14.7%. If I'm doing this one, let's say I'm doing total operating expenses. So I take 237 divided by 803 times 100, and I get 29.5%. And so then this becomes the number that you kind of look at then, okay? If I'm using, you do net income the same. You do 48,000 divided by 858 times 100 gives me 5.6%. It's a good way to see it too, because again, when you're dealing with large numbers, sometimes stuff can get lost. Because you can say, oh, look, my revenue went up, my income went up, but you can see that in 2020, your net income as a percent of your net sales revenue is much higher than it is in 2019. So that's good. If you are doing it as a balance sheet, then total assets is your base. So everything is a percent of total assets. So I take cash divided by total assets, and then take that times 100 and get 3.7%. Or I can take common stock as a percent of total assets, take that times 100, and I get 29.8%. If you were doing this in Excel, it'd be super easy. You just do one calculation and carry it down. If you're doing it manually, it's a little bit more annoying, but it's kind of repetitive, but it's not. Everything is a percent of your base. So why do we use this? It's really helpful when you're comparing two different companies, especially if they're different sizes. So you lose this value base, this value bias. That can go away. If I'm just looking at percentages, I'm looking at performance. And so that's when you can see that even though this company might be smaller and have less in assets or less in income, it's actually performing better. So for instance, a potential investor would really want to look at it this way. They don't want to be swayed by the big numbers. They want a better return on their investment. They're looking for better performance. And so comparing firms of different size, I think that's when this is most useful here. The example they give you is they're comparing Smart Touch, the company we've been following, with another place. And I think I think Smart Touch is bigger, but if we look at everything as a percent, so this is a common size income statement. I do that vertical analysis that I just did, and then I take out the numbers and I just report it in percentages, just percentages. And so obviously this is going to be 100 for both of them because that's my base. But here you can see that net income as a percent is much higher for the smaller business, the learning school. And if we were just looking at numbers, we might not notice that. And so then you want to look and see, why. And you can see that this is a lot higher than this one, the income before taxes. The operating income is higher, but this is where you're really going to see it. Look at this gross profit compared to this gross profit. And here's the reason. It's these guys, learning school, are doing a much better job controlling their expenses, their cost of goods sold, and well, their selling expense is a little bit higher, but their cost of goods sold is significantly lower, and that is probably their biggest expense. So they're doing a good job of keeping their cost of goods sold lower, or they're more efficient there, which is driving up their profit. So that's a really important way to look at it. You can also use this, or especially use this for benchmarking, comparing one company against another. A key competitor, for example, Target is going to look at Walmart's numbers, and Walmart is going to look at Target's numbers every single day. So a key competitor, or just the average, the industry average. I love a nice graph. I think it shows, this is the same information we just looked at in that common size income statement. And this you can really see, look at their cost of goods sold compared to their cost of goods sold. you can see there that they're doing a much better job of managing that, which is why their net income is so much bigger as a percent than their net income. And so sometimes graphs can be used to be misleading, but a lot of times it just really makes the numbers jump out at you, or at least send up some red flags for you to go investigate. So it's a very effective way to show it. So let's do, I've got two quick problems here on vertical analysis, then I'll stop this one and we'll start with the next one with ratios. So vertical analysis, this is a balance sheet. So total assets is my base, right? So I'm going to show everything as a percent of total assets. So 80,640 divided by 280,000 times 100 is 28.8%. 56,840 divided by 2,800 times 100 is 20.3%. And 142,520 divided by 280 gives me 50.9%. And then this is obviously 100 because that's the base. And then we do the same thing for 2017. 80,575 divided by 275, and I get 29.3%. 54,450 divided by 275, and I get 19.8%, I think there. And 139,975 divided by 275 times 100, and I get 50.9%. And then this, of course, is 100. And so you can see that your cash as a percent of total is going down a little bit. Your inventory went up a little bit, and that's probably why. You probably bought more inventory. Your fixed assets are about the same. And so that's a way to compare two different time frames.